The world has been rattled by an epoch-making crisis, which has caused significant harm, shuttered businesses, put livelihoods at risk, and protectionist reactions have cast doubts about the future of globalization. As we start rebuilding, we need to seize this opportunity to build a better tomorrow, one which achieves a more balanced, fair, and ultimately a more sustainable world. Globalization has helped raise living standards around the world in recent decades, and will continue to be vital for the future. Finance will continue to play a central role in international business. Making sure capital is available when needed will be crucial in shaping the global post-COVID economic recovery. Investors will provide the funds required to help companies around the world stimulate growth and create jobs. They will also help bring about the transition of our economies to a more sustainable future. Luxembourg will play its part. Our unique expertise in international finance connects investors with projects. Our ecosystem, our toolbox of investment vehicles, and our stability offer an ideal platform for financial services to operate on a worldwide scale. Luxembourg contributes to building a better, stronger, more open, and more sustainable tomorrow.
Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Hello, Happy New Year, and welcome to today's event, which is focusing on the topic of digital capital raising. Now, digital capital raising is obviously a very broad topic and could cover a vast variety of really quite disparate use cases. We could, for example, argue that today's securities services industry is already providing the infrastructure for digital capital raising, with securities, after all, being largely dematerialized these days and functioning essentially as book entries into a computer-based system rather than necessarily paper bearer bonds that you shove in your mattress below your bed. But instead, today's event will instead focus on the impact of one particular technology, which, while launched to little public fanfare in 2008-2009 by Satoshi Nakamoto, has over the past 10 years largely captured the public imagination in a way that few other financial services technologies have. And here, obviously, I am talking about distributed ledger technology, DLT, or blockchain. The astronomical growth in value and the volatility of cryptocurrency assets like Bitcoin is the focus of lots of the public attention. But other use cases also have the potential to reshape financial services. Tokenization and NFTs, for example, could bring new liquidity to a range of asset classes that are not currently tapped, while DLT itself has many potential applications within the existing securities services industry. Of course, the regulatory environment in which these services are delivered is also crucial, both in terms of, obviously, investor protection and in terms of harnessing the potential of DLT. Today's event will look at this topic from a variety of different angles through short interviews with experts and practitioners, all of whom are here today to share their views on the changing environment for digital capital raising that is enabled through DLT technology. There is a hashtag for today's event, so if you would like to talk about this on social media, please use the hashtag LFFDigitalAssets. And without any further ado, let's get started. So to kick things off, I'm first delighted to be joined by Marion Laboure, who's a senior economist at Deutsche Bank in London, as well as a lecturer at Harvard University. And she obviously has a wide-ranging background in the private sector and public policy and monetary policy experience with a wide array of institutions ranging from the European Commission through the IMF and including, of course, the Luxembourg Central Bank as well. And she's here to talk to us today about the topic of crypto and sustainability. So just to kick things off, firstly, it's nice to have you here today, Marion. Thank you for joining us.
Thank you very much, Chris, for the invitation.
Just to kick things off, at the tail end of 2021, if I remember correctly, you authored a new piece of research where you stated that over the past 3 years, the market cap of Bitcoin has gone from somewhere in the US dollar 70 billion range to over 1 trillion. But at the same time, obviously, the energy consumption of the Bitcoin network has also quadrupled to exceed over 200 terawatt hours. Could you perhaps give us some sense of the dynamics that have led to this and what it means from a sustainability perspective?
Yeah, sure. So first, let's make the difference between energy consumption and carbon footprint. They are very different. Carbon footprint depends on the type of energy source to mine the cryptocurrency. So just to give you some numbers, we have almost 80% of Bitcoin global energy consumption, which is generated from non-renewable sources, such as coal, for example. And we have less than 40% of renewable, which used to mine cryptocurrency. So actually, most miners, due to the lack of economic incentive, rely on traditional carbon-emitting sources. So just to give you some ideas of what it represents in terms of stats, when we mean just 1 Bitcoin, it consumes a larger carbon footprint than nearly 2 billion Visa transactions. And the Bitcoin's annual energy consumption could power half of the British household. So this is absolutely huge. And in terms of what we expect and where we are going to, if we look at private sector industries, companies have pledged to become carbon neutral very soon. And in the public sector, we have almost 200 countries which have signed the Paris Agreement, which aims to limit the rise of global temperature to 2 degrees Celsius by reducing greenhouse gas emission. And in terms of study, one study predicts that Bitcoin alone could increase global temperatures, but exactly this amount within 3 decades.
Okay. What could be done potentially to reduce the carbon footprint, therefore, of Bitcoin? What would your suggestions be there in that case?
So you have a couple of solutions. First, the most extremist is to ban Bitcoin. And for example, it's what China did. China banned cryptocurrency mining in September last year. And the country has gone from powering 75% of global Bitcoin mining activity to officially zero. I say officially zero because many believe that miners are still operating in China by using a VPN. So this is the most extremist way. And there are a couple of possible solutions for decarbonizing crypto. And I would tell you 4 different solutions. First one is to transition to renewable energy sources, for example, by government intermediation. It's what the US government did in 1980, for example, when it passed a large tax breaks for natural gas producers. And consumption of coal-generated electricity in the US declined from 57% in 1985 to less than 20% last year. Another example, it's what El Salvador is trying to do with geothermal energy from volcanoes. It aims to mine crypto with volcanoes. Second solution is to impose taxes to disincentivize carbon-fueled crypto mining, for example, with a tradable right to emit. Third solution would be to switch from proof of work to proof of stake protocols or to verify transaction of the blockchain. And it's what we are seeing with the Lightning Network. And just to give you some idea, it's what Ethereum, so this is the second largest cryptocurrency by market cap, which is trying to do because it aims to fully transition from proof of work to proof of stake system by mid this year. And the last solution is to pre-mine the tokens. So for example, you can mine all the tokens, so no more energy is required to mine a new token. And this is, for example, the case of the crypto XRP.
Okay, I mean, those are some interesting ideas, and it is interesting that this is quite a topical issue. I mean, I seem to remember that last week Eric Tierden, who was the vice chair of ESMA, was on record as stating that the proof of work model, which is the model that underlines the consensus protocol of Bitcoin, should be banned because of the energy consumption that it requires. And also that if this weren't the case on the renewable energy front, it would be a shame that the renewable energy production was just purely devoted to essentially mining cryptocurrency. So what do you think? Do you think a move from proof of work to another system like proof of stake would potentially be the most kind of viable option? What would you say? How would that help the sustainability of crypto assets generally?
Yeah, that's a good question. And actually, many cryptocurrencies like Bitcoin are energy intensive by design because you need to mine to find the remaining cryptocurrency. And you have several ways to mine these cryptocurrencies. And for example, Bitcoin is using a lot of energy compared to many other cryptocurrencies. But the good news, again, is that not all cryptocurrencies used proof of work. So proof of work, this is the protocol that is used by Bitcoin. And it's also possible to transition from proof of work to proof of stake protocols that verify transactions off the blockchain, like the Lightning Network is doing. Mm-hmm. So again, these are possible solutions. Ethereum is due to fully transition from proof of work to proof of stake system by mid this year. And we can also implement the Lightning Network, and it's what El Salvador is doing.
Okay, and just as a last question then, what actions do you think should be taken to align DeFi and the green finance agenda post COP26? A kind of topical question.
Yeah, that's a good question. And I would say I was pretty sad actually, but the environmental impact of cryptocurrency was barely mentioned at the COP26. Mm-hmm. And overall, there are probably not enough efforts and progress which are done in this space. But there are still few initiatives that remain, fine, limited, but they are here. For example, in terms of private initiative, I'm thinking about the Crypto Climate Accord. Basically, it's like a dozen of crypto market participants which are aimed to decarbonize the industry by using greener blockchain technology, carbon accounting, and carbon offset procurement. And if we look at what can be done in the public sector, I think governments, regulators, institutions need as well to have a voice. This is something which is done, by the way, in Europe. The European Parliament has proposed green amendment to its markets in crypto asset regulation, MiCA, which will be subject to political renegotiation until mid this year. And the amendment is going to require companies to disclose energy consumption related to crypto activities, for example, such as mining.
Yeah, so by the sounds of it, I mean, maybe I'd ask you, would you agree? By the sounds of it, we're really at the very early stages of this issue being kind of tackled by the crypto industry. It seems very much like, there's still a lot of work to be done, both on the regulatory side and in terms of private initiatives.
Yeah, absolutely. It's a very early stage initiative, so many things had happened in 1 year, especially since Elon Musk was pretty vocal. Despite the fact that it's not a new thing, everyone knows that cryptocurrency are consuming a lot of energy and the carbon footprint is pretty high, but it remains pretty a new thing. Yeah, and what we probably miss is a robust data to be able to compare with robust, solid evidence, what is the carbon footprint and the energy intensity.
Yeah, absolutely. Data is a huge issue, definitely, in all sorts of sectors of sustainable finance at the moment. Okay, well, that's all we have time for today. Thank you very much for joining us, Marion, and thank you.
Thank you very much, Chris.
Well, I'm now delighted to be joined in the studio by Tobias Seidl, who is the co-founder leading on product strategy and regulatory matters of STOKR, which is an alternative investment marketplace here in Luxembourg. Nice to have you here.
Hi, nice to meet you. Thank you.
So just to kick off, today I think we're going to talk a little bit about tokenization as a topic. How maybe you could share some of your insights if we look at a sort of a spectrum of assets from traditional securities ranging through then security tokens and into other forms of crypto assets and cryptocurrencies. What would you say kind of differentiates these sorts of asset classes?
I think in order to understand the differences between security tokens and crypto assets and traditional securities, I think we need to go a little bit a step back and think about what is the main idea of crypto assets. Think about Bitcoin at that time, right? The idea was basically to create a framework, a trusted framework where parties could transfer values, right? Without any need of a middleman. Right? This is already written in the Satoshi Nakamoto's white paper. Yeah. And that's also the idea of security tokens. So all of them, when you issue securities or other utility tokens or the like, they all have this idea of the direct relationship between the issuer or the owner of the asset and the transferee. So this step we took to a next level. And when you think about security tokens, it's basically the proof that you are entered into an investor register of an issuer. It can be a company or a fund or the like. And in this sense, you have a direct relationship between the issuer and the investor. And this means control over the asset, right? Risk mitigation. It means also transparency. And I recently read a study a few days ago, and they asked what do normal market participants from the legacy industry expect from security tokens. And there, not astonishingly, it comes instant settlement, right? So this peer-to-peer transferable component and then the instant settlement, I think, are the main advantages of security token vis-a-vis traditional securities. And the differentiation of crypto assets and securities tokens I would not make, because I think it's rather an evolution of that idea than something totally different.
Okay, so they're really part of, as you say, part of a continuum on the crypto asset side, with the kind of the differentiating factor with traditional assets being really to do with that direct, unintermediated relationship with an issuer, and then the instant kind of settlement that comes with the platform. Now, obviously, STOKR platform's been running for a couple of years. What sort of investors do you see making use of your platform, and what are they kind of trying to achieve through their investments there?
So last year alone, we gained around 10,000 new investors on our platform. And what we see are two different types of investors. One is investors are crazy about crypto, loving this technology, and trying to find a lot of possibilities to invest into. And then there are there's a bigger group, I would say, who are interested in new investment opportunities. So I think the driving point to go on our platform is obviously not only the technology. It's obviously also when you cannot provide attractive investment opportunities on an alternative investment marketplace, the technology does not matter. So I think we are pretty proud that we have found specific products which are very attractive to our investor audience. And one of them I will explain a little bit later is, for example, the Bitcoin mining node, where you can directly invest into Bitcoin mining.
Okay. So yeah, no, that's very interesting. Just to understand that it's, the technology is almost in some respect kind of secondary to the investment opportunity. It's really about liquidity or new assets that is the driving force, with then the technology sitting really more as a solution to enable that.
So double innovation.
Yeah. Just looking forwards then, I mean, obviously, I think we're all waiting in bated breath, and I think other speakers are probably going to touch on this as well today. We're all waiting in bated breath in Europe for the introduction of MiCA and, a kind of an established regulatory framework for both on the digital assets and cryptocurrencies. So, I mean, how do you see specifically with respect to tokenization, how do you see the the regulatory environment in Europe developing going forward? What do you see from a regulatory perspective and then maybe a business perspective as well?
So what do we see in like the whole regulation of tokenization and blockchain? I think is a kind of like a tendency. So when you can think of it as a pendulum, right? Yeah. A tendency to over-regulate this market totally, yeah. Because when you think about, for example, MiCA, given you like you're a hairdresser, you want to give out a voucher, right? Yeah. You give it out in paper form. You're not regulated at all. Mm-hmm. Would you dare like to do it on blockchain? There's a risk that you fall under MiCA and then you're suddenly a regulated entity. So I think there's a tendency of over-regulation there. Yeah. But I think like as more market participants come into this market, everybody will understand like really like the underlying risks, and adopt also like maybe like these future regulations, but also the current regulations to what blockchain actually provides. And I think there's something very interesting when you observe like the regulated market is people think at banks or custodians, because like they influence very much like how regulation is right now, they have to adopt to a regulation which is made for their specific security infrastructure, mm-hmm. right? Security market infrastructure, which has total different risks than blockchain. Mm-hmm. So when you think about, for example, also about the shareholders directive, right? Mm-hmm. Shareholders rights directive. The shareholders rights directive was created because how like security token markets are markets are currently structured, mm-hmm. right? So you don't have a direct relationship between the issuer and the investors. That's why you need like the regulation telling, okay, but there must be like a link between a broker and another broker and another broker, and who is talking about the securities, who is owning it, who can communicate and the like. So I think there we see a lot of, in the future when there's more adoption coming, and this is what we currently see also from professional managers like hedge funds, alternative asset managers, but I think like the likes of Allianz and Commerzbanks and whatever BCLs will come, right? And as soon as like more market participants are using blockchain technology, the understanding of really the underlying risks will increase, and then also like current regulation will be adopted mm-hmm. to the risks, and maybe some regulation will completely go away because it's not necessary mm-hmm. anymore, and then we will review future regulation.
Okay, so unfortunately, you know, the new incoming package, not necessarily a silver bullet that will solve all problems, but rather one thing that we kind of see is as the kind of basic infrastructure essentially for security services is changes and adopts new technologies. It's really then the evolution of the regulatory framework to adapt to those changes in infrastructure that is going to really kind of like drive adoption, I guess, more than anything else, more or less, yeah?
Yeah, absolutely. And I think there's sometimes like also a misconception about regulation. Some people think you need regulation first to have innovation. But when you look at the long history of how technology works and how new opportunities were created, actually first you had like the car, you know, or you had like telecommunication, or you had like the paper, and then we were thinking about how to regulate this efficiently, and I think this step still has to come into the market.
Yeah, traffic lights come after cars, basically.
Yes. Exactly.
So, and just a final question, I'm already aware that we're quite short. What's the most interesting tokenization project that you've had on your platform so far, and why is it interesting?
I think one of the projects we are the most proud of is the Bitcoin mining node, mm-hmm. right? We have analyzed like the Bitcoin mining market over the last 2 years, and actually what we found is that there is no financial instrument where you can directly invest into Bitcoin mining. Mm-hmm. So we were going to Blockstream, and we were creating together like an instrument where you can directly invest into a specific Bitcoin mining entity, mm-hmm. and get actually the Bitcoins mined out of this project. And how we did this is we thought, okay, what is actually the underlying asset? And the underlying asset is a hash rate contract actually with the mining company, right? So we securitized under Luxembourg law this hash rate mining contract, transferred like the risks to the securitization vehicle, issued notes, tokenized obviously these notes, And then these specific security tokens represent then a specific hash rate and in the mining facility, which gives them like a very clear view what you can expect as a return, right, and where are the risks are lying. So it's a very transparent instrument, and it goes very well. We constantly sold out on the platform as soon as a new tranche comes out, but it's very innovative, and we're pretty proud of that.
Okay, well, great. Thank you very much for joining us today. That's all we have time for, and yeah, thank you.
Thank you very much for having me.
Thank you. Well, I'm now delighted to be joined by Benjamin Duve. Benjamin Duve is a director at the Digital Asset Unit of BNY Mellon and has been an enthusiast for digital assets and DLT technologies all the way back to proof of concepts that he ran in 2017. Moreover, he's also an industry veteran on the security services side, working at several major institutions in the field of custody here in Europe. So thank you very much for joining us here today, Benjamin.
Thank you for having me, Chris. Excited and looking forward to a small chat.
Thank you. So just to kick off with, maybe you could talk us through some of the rationale behind BNY Mellon's decision to set up a digital asset unit back in, I believe, early 2021. What was the rationale there?
Well, you can see what we do. I think it's always a great way to best grasp it. We're there to help our business lines on their DLT journey. We have an enterprise-wide view on digital assets, and we are subject matter expert, actually in a quite diverse team with different backgrounds. Due to the unit, we are now better connecting the individual pieces we have in the organization, and we look out that there's a coherent overall strategy and rationale rather than these tactical individual one-offs you see still in the industry these days. Beyond that, we engage with clients, with the ecosystem, but also with academia to be the thought leaderships for the industry, but also within our own organization. And what we do a lot also is share our expertise and engage with our clients to get their feedback on what we should and shouldn't do, what they're expecting of us, but also to share how we organize, how that helps the organization move more forward, and how we are driving that change together and in partnership with our individual businesses we have in BNY Mellon.
Okay. I mean, it's quite interesting, really, because obviously BNY Mellon is an organization with a history of somewhere in the region of 200 years, if I'm not mistaken. So how, and obviously, DLT and blockchain are fairly new and upcoming technologies that are shaping the security services industry. How do you see yourself bridging that gap between, the incumbent sort of security services environment and fintechs and new upcoming technology?
So I think first off, if you see the age of the organization, which vastly outspans me, obviously, I think you're right. I think 237 something years. It really underlines there was innovation all along. So innovation is not new to the organization, and even if it sounds very revolutionary, I think there were other steps in the industry history as well, right? Going for different forms of security, digitizing the industry early on, going from paper printed things to computer stuff like that. So I think it's natural within the organization. But how we bridge that gap, I think it's straightforward. We look at what our clients expect from us, and they very clearly indicate they want that trusted third-party BNY Mellon they have been working with for sometimes also centuries, and to bring them the new assets and help them and help the industry evolve towards a more DLT-based capital markets. They don't really say DLT-based infrastructure, for example, but they like the benefits it promises. So what we do is We build those capabilities for our clients, as we, for example, do with our integrated custody services, so they get the same seamless experience, and the resilience and the asset safety and security they are used to, but in a very minimal invasive manner for them, right? So it's just an additional asset class, but we enable them to handle that. Beyond that, when we look at digital securities, I think what we do there is we look with our clients we look more at what is technically possible, and we ask them, what do you expect of the capital market of the future? And we always hear the same thing. We want it to be faster. We want it to be more resilient. We want less exception handlings. We want things streamlined, and we want to look at certain aspects, how the industry has evolved very organically, and maybe there's a way to design it better and more streamlined going forward. And I think that's what we do. We bring those assets in the safe, secure, resilient manners to a client. We do a lot of the heavy lifting, integrating it, but also help the industry build out the future DLT-based capital market infrastructure.
Yeah. And just to come back to that, I mean, you've mentioned a couple of times there that you're in regular discussion with your clients about digital assets and their potential value. And I was wondering, maybe you could give us some insight into the dynamics that you're seeing there. Are you seeing your clients express a greater interest in recent years towards digital assets and crypto assets, or is that still something that is sort of more a proactive kind of ask on your side?
So there are two aspects to that, right? So of course we see our clients actively asking about crypto assets, and that's why we have started and announced already early in the last year as one of the first major industry players that we will offer integrated digital asset custody to our clients, because it was an ask of our clients. They said, this is an asset class we want to safekeep, and we want to safekeep it with you. We have fund services today because our clients came to us and asked, we want certain services around funds for those crypto assets, digital assets then later overall. And we started to build those capabilities alongside our clients to be able to service a client request and desire. If you look at the more broader digital security bits, which I think is the second bit, that's a new asset class which is evolving. I don't think so. It's actually how do we better handle our current securities, or what we do today in a better, more efficient manner, maybe later on also add new asset classes. And that is a more two-way discussion, because of course our clients expect us to help them navigate, but also to build better solutions for them in the future. They would, I think in many cases, rather reap the benefits and go on that journey with us. They don't actively tell us we want digital assets per se. They want to say what you do around digital assets. How can we be part of that journey, and how do we benefit? I think that's a very important question a lot of clients ask us.
No, that's very interesting insight to see, A, the client push, but then also B, your sort of mutual relationship with your clients on driving the industry forward. Maybe we just move over to the other side of the equation. I mean, maybe you could talk a little bit about your interactions also with fintechs. Do you see value in terms of working together with actors outside of the organization in that respect?
Well, of course. I mean, if you look at this new technology and emerging technology, there are many different players who work in that field who come to us, fintechs, with new ideas, new approaches, and how to do things. And we actively engage with them because, first of all, we think we don't have to build everything ourselves. We can partner and do stuff together with others. And secondly, that interaction is a two-way street, because we also bring expertise to the table. I mean, we have been handling clients and assets for hundreds of years. We do actually have clients and volumes to bring to the table if we see something interesting. And I think that's also, regulation, of course, and the rules of the road or the markets in this case. So I think that's a great value we bring in that conversation. And as you can see, BNY Mellon is partnering with fintechs. we also buy stakes in fintechs, as we've seen with quite a few market announcements. And I think that's important to keep in mind. And sometimes it's difficult to pinpoint, but now I have a great example. We've just seen it in Germany recently, a fintech or crypto-originated company buying a regulated bank to be able to offer regulated services within Germany, and I assume also passport throughout Europe. So there is a mutual benefit in working together for both sides.
Yeah, I think clearly that linking up that or marrying that regulatory expertise with new technology is something that is certainly a valuable proposition. And I'm aware that we're running out of time, so maybe one last question. Looking, prognosticating forwards 5 years or so, do you think that we'll see some sort of convergence between virtual assets and digital assets, or do you think that these will still sort of operate under parallel tracks for the years to come? What would you say?
So first off, as said, we as BNY Mellon want to make crypto or digital assets as seamless for our clients as possible. So I think they can be assured that all the assets out there will they will be able to handle in the same good, high service, efficient, resilient manner they're used to. For the industry overall, I think there is one important aspect. It looks, there is a regulatory topic to it, but it looks like we will see asset class by asset class, bit by bit, moving and trying out to be properly handled as digital assets. And then it's up to the clients if they choose those benefits digital assets bring, and then that grows more or less. But 5 years, I think we will see some asset classes partly being handled in digital assets and having crypto as an additional asset class clients request and can handle, hopefully in our case, through their current banks. I'm not sure if everybody in this industry is as fast as us to enable that journey for their clients currently.
Okay, so seamless at BNY Mellon at least. Okay, well, thank you very much. That's unfortunately all the time we have today. Thank you very much for joining us, Benjamin Duve from the Digital Assets Unit at BNY Mellon.
Thank you, Chris, for having me, and greetings to Luxembourg. Hopefully next time we meet in person again.
Indeed. I'm now delighted to be joined by Solenne Niedercorn-Desouches, who is a long-standing expert in the private banking and portfolio management industry. She's also got significant experience in terms of setting up regulated entities here in Luxembourg, as well as being an entrepreneur in her own right, setting up a regtech here in the country. Now she works as an advisor for fintechs and VCs, as well as also being a conducting officer, a board member for a fund here in Luxembourg, investing particularly in that sector. A pleasure to have you here today with us.
Thank you very much for the invitation, Chris.
Thanks. So, as I mentioned, you're an executive director here in Fabric Ventures, which is a VC that's investing, if I understand correctly, into blockchain and decentralized data networks. Perhaps you could talk a bit about the VC industry as a whole, and then also Fabric Ventures in particular, in terms of what the trends are, or what your hypothesis is with regards to the kind of like the blockchain sector.
Okay, thank you. So VC industry remains a bit niche compared to other industry in the financial sector. If I give some figures, VC funding in 2021 represented $650 billion worldwide, globally, so in all sectors. And regarding crypto funding, it represented in 2021 $30 billion US dollar. So you see it's quite niche in the whole area of VC. I wanted to mention three main funding rounds that happened last year that struck me quite a lot. The first one is FTX Trading. So FTX is a company that is based in Bahamas, and it's a crypto asset derivatives exchange. And FTX raised for Series B $900 million, and the valuation of the company is currently $18 billion. The second one is STOKR. It's a French-based company. I'm sure you've heard of it. It's a fantasy sports NFT game. And the funding round, Series B funding round, was $680 million. For a valuation of $4.3 billion. And the last one, which is the most incredible one, is MoonPay. So MoonPay allows users to purchase cryptocurrencies using traditional payment methods such as credit cards. And MoonPay raised for the first round, the seed round, the first round, $555 million, and the valuation is already 3 years after its creation at $3.4 billion. So you see, you have those emerging companies in that area of I would say, the Web3 that really have already a huge valuation. If you take a look at VCs investing in crypto companies, one of them, of course, is well known. It's Andreessen Horowitz. Andreessen Horowitz raised a fund of $2.2 billion last year. So already VC firms such as these one have a foot in that sector. And if you take a look at the proportion of companies in which those VCs invest, you have a proportion of 50% of investment that go to infrastructure, custody, and decentralized finance. 43% in everything that relates to investing, lending, or trading crypto assets, and the last remaining 70% go to everything that relates to NFTs, DAOs, or metaverse. So in that context, Fabric Ventures is a big family, I would say, of investors and people really passionate about crypto since years, and seasoned entrepreneurs and very well experienced VCs. And what they're interested in investing is exactly this. So investing in everything that will enable the expansion and the development of the open economy. So open economy, when I say open economy, there are different subsectors. I would say open media, open work, open healthcare, and open finance, for instance. So it's very, very wide. So it really requires some competences in that sector, and be surrounded by an ecosystem of advisors that you don't necessarily find in traditional VCs.
Maybe just talking a little bit, if I understand correctly, Fabric VC has done two funding rounds so far, one in 2017 and one in 2021. Maybe you could talk us through some of the investments that you think are particularly pertinent in that kind of.
That's a good point, because it's a bit vague, what I said. So 2017, so the fund was sort of proof of concept to validate the interest from investors, and so they invested in STOKR, early stage in that company. Another investment they did was in 1inch. So 1inch is an aggregator of decentralized exchange. 1inch, now you have a weekly volume of $3 billion every week. So it's quite impressive. They also invested in Polkadot. So Polkadot is a layer 1 protocol. And it's interesting because usually VCs invest in equities, but VC in crypto, they invest either in equities or in tokens. Directly. So instead of investing in Polkadot, the company, they invested in tokens. Yeah. So you see there is, you can invest either in equity tokens, but also agreements for future token, what we call SAFT. For the fund 2021, the first closing was 120 million, not billion, million $, with major LPs such as the European Investment Fund and Lux Future Fund. I would like to mention two of them. One of them is Angle. So Angle is a protocol, and Angle can issue stablecoins. but in a decentralized way. So in a centralized stablecoins are backed by fiat on a bank account. Decentralized stablecoins are backed by crypto assets in smart contracts. So you see they are able to issue stablecoins in a decentralized way, but with stability and capital efficiency. Either you have one or the other, but they manage to do both at the same time. And another investment that is interesting is in the domain of NFTs. I said it was an interesting niche in which VC specialized in crypto wanted to invest in. Immutable is an Australian-based company, and Fabric joined for the, I think it was the first seed round, or no, Series B, sorry, $82 million US. And what they managed to do is they created what they called Immutable X, which enables the trading of NFTs within a blockchain game. So you see it's a mix of gaming and NFTs at the same time. Very interesting. This is also the market of Sora, which is also mixing, I would say, those two worlds together.
I mean, fascinating. And I think one of the things that really strikes me there, well, there are two things that really strike me. First is just the breadth of potential investment opportunities and, you know, the kind of wide area of, you know, potential interests that they can cover. And then also the, you know, the newness of some of these companies. I mean, you mentioned MoonPay has only been set up for a very short period of time and has a valuation that's essentially through the roof. I mean, is there any sort of particular skills that you need or a particular approach that you take as a VC that's really investing into, A, something that's so broad and diffuse, and then B, also something that's kind of at such a bleeding edge at the real forefront of technology?
Okay, so that's very interesting because now there is so much cash available that and entrepreneurs can really decide with whom they want to be supported and backed. What is interesting within Fabric, and it really struck me, is the expertise that the analysts, the investors, the partners have and can really support the companies of the portfolio of the different investment vehicles. So it requires an expertise in blockchain, in all the protocols, so the technology itself, but also the security elements, but also the regulatory aspect. So you see, it's very wide. Fabric doesn't work, we don't work just Fabric family, but also with a range of experts surrounding the core team and providing support when needed, when there is a due diligence to perform on a company, when there is a need for one portfolio company to develop a new product. And another element that I find particularly interesting in that area, in that everything related to crypto companies, is the capacity the investor has to support a company in building its community, because everything relates to community in that Web3 area, which is not the same as in Web 2. So there is also a capacity from the investor to support the portfolio companies building their communities.
Fascinating, really, really excellent. Thank you very much. I just want to touch on one of the other things that you do as well. You're quite well known here as the host of a FinScale podcast, which, if I understand correctly, you launched back in 2020. It's a French language podcast that looks at some of the big changes that are going on in fintech, in the fintech space, and that has, I think, something like 100 episodes already under its belt. Could you perhaps maybe talk through some of the most interesting things that have come up in that podcast? And I assume that kind of supplements your knowledge on the VC side as well.
Okay, so yes, I discovered with my guest and with the audience a lot of different themes. We discovered buy now, pay later, revenue-based financing, neobanks, etc. So many different, I would say, businesses in fintech. But what struck me the most is the capacity all those entrepreneurs have to build a strong team and make their vision come true. It's so impressive to see. I had recently an interview with a guy who launched his company just 1 year ago, and the way they are only 4, the way they develop the product, and it's a beautiful product, with already a very strong community and managing to raise funds at the same time, it's quite amazing. So this is first thing, it's, I would say, the persons I met. On the other side, when it comes to the businesses themselves, what struck me is also everything that relates to sustainable finance. I know, of course, as you know, SFDR and all the taxonomy that the EU has implemented. What is interesting is the way some investors really tackle that point very seriously, and they have in their portfolios companies that are really aligned with their own values. So they manage to be very aligned, choosing the right portfolio companies, choosing the right investor, and having a due diligence process that is very, very strict. And I particularly recommend you. The episode is one of my favorite ones because of that alignment. It's an episode that I recorded with Olivier Mathieu about the Evergreen Fund 2050. It's really impressive.
Oh, well, listening for both me and all of the rest of the audience, I suspect, after this. And just as a last and final question, I mean, bringing together your experience, obviously, as working for a VC and your experience also in the podcast, where do you see the finance industry as a whole going, and what would your advice be towards incumbent institutions in financial services?
Okay, so I see that I really feel, I'm sure we all feel that an acceleration of the transformation in that industry is going very, very fast. Of course, there are every year new themes and new trends. Like last year it was really buy now, pay later. Next year, so this year it's revenue-based financing, for instance. But I would say the transformation is going faster and faster. And my advice would be really to start understanding all the changes and trying to understand as much as possible the way the entire industry will change. And it's very interesting to see, and I'm really happy because in Luxembourg, the regulator is really reactive and proactive when it comes to catching the new trends and really trying to understand from the beginning how it's working. So quite interesting, but I would say my recommendation coming from traditional finance is really to understand how things are changing and really to consider that it's going faster and faster.
Yeah, so listen and learn. Okay, well, that's all we have time for. Thank you very much for joining us in the studio today. It was a really interesting discussion.
Thank you very much, Chris. Thank you, everyone.
So I'm now delighted to be joined in the studio by Jean-Baptiste Graftieaux, who is the CEO for Europe of Bitstamp.
Hello, Chris. Hello, everyone. Thank you very much for having Bitstamp today. It's a real pleasure to be here.
Thank you. Obviously, you have extensive experience also in the payments sector with stints at eBay and PayPal, as well as time previously in the compliance function of Bitstamp here in Luxembourg between 2014 and 2016. Bitstamp obviously is a relatively well-established crypto exchange set up in 2011 and has been in Luxembourg then since 2016. How would you say the environment in crypto has changed over the 10 or so years?
Absolutely, it's very interesting because the ecosystem, has been founded in 2009, so it's just 13 years ago that the first Bitcoin has been created. Bitstamp has been in a space for almost 11 years now. We have been founded in 2011. At the time, it was probably one digital asset on the market. But very rapidly, we have seen many projects with blockchain, for instance, emerging, complementing the ecosystem. And for Bitstamp, our journey has been, becoming regulated at the early days of the company. There was a fundamental, culture point from the shareholders and funders at the time to become the first regulated crypto exchange in Europe. Hence, the payment institution license, which has been granted back in 2016 by the CSSF in Luxembourg. Interestingly, today, we see almost 15,000 digital assets. So from 13 years ago to more than 50,000 today. We see many projects in the blockchain, many institutional players, entering the space, such as, banks, but also commercial companies. So in the last decade, I would say framework, but also the ecosystem has changed, very, very significantly. We see a lot of VCs entering the space as well. More and more regulation, which Bitstamp is really supporting and taking advantage for building trust and also working very closely with the entire ecosystem.
Yeah. So just to drill down on that regulatory point first for a little bit more. I mean, in Luxembourg, you're regulated as a payment institution, and then you also have a virtual asset service providers registration, if I understand correctly. Could you perhaps explain how those two, well, one license and then one registration kind of help support your business?
Absolutely. So I think back in the days, there was huge attention for us to become regulated in order for us to attract institutional clients such as banks and brokers, investment funds or family offices. It has been really in the DNA of the company in the sense that we are subject to the same regulations as our clients today. And interestingly, if we look at our volume, we have more than 80% of our trading volume, which is generated by institutional clients, which means banks or brokers or payment service providers. So for us, this is a key, in order to build our business and enhance our business to be regulated, which we have been doing since the early days. So as you mentioned, we have a payments institution in Europe, which we have passported across the different European countries. We are also regulated in the US. And the VASP for us is very important in order to be able to market our activities in the different countries where we are VASP registered. It's quite complex and quite fragmented. Each country has its own regulatory framework. In some countries you need to apply for registration. In some other countries you don't have to, or it's another type of license. Which means that as a crypto exchange, regulated crypto exchange, for us the key will be having MiCA to come into force at some point, hopefully in the next 24 months, to facilitate the go-to-market to all the countries, to have the same level playing field and at the same time being regulated and continue our expansion and geo-expansion specifically for institutional clients, which is our core segment.
Yeah. And so how would you see what added value would you say that MiCA will kind of bring to your exchange? Is it just harmonization? Is it the passporting? What exactly is...
Absolutely. I think, Chris, you touched the two key points here. Is really harmonization and also to give an easier access to the market. Today, if you want to operate a crypto exchange, you need to apply for different registration in each country. So the passporting rights or the passporting principle is not part of the VASP regime today. It's a very local approach, which means for us, MiCA being passportable in the future will facilitate the geo-expansion, but also give a faster and easier access to the market. Like payments institution or banks today, you become MiCA in one EU country and then you can easily passport in the other countries. So we are very supportive of MiCA, definitely, and we will expect the regulation to come into force as soon as possible as a crypto exchange.
Yeah, I think we're all definitely waiting for that sort of regulatory environment in Europe to kind of take full form. Just to talk a little bit maybe around, I mean, obviously you've talked about how you're a regulated and primarily institutional serving crypto exchange. Could you perhaps maybe talk about some of the requirements that go into the asset selection? Because obviously there's a wide variety of different crypto assets these days, and I don't know how.
Absolutely. It's a very interesting question. So just to give you some size of number of assets that we are looking at, we are receiving dozens and dozens of projects every day, every week. I think many players would like to list their assets on our platform, which is great, of course. But at the same time, we need to apply very stringent requirements. Usually what we are doing is looking at the technology, the security, the business plan, ensure there is a team behind, business model, and also the audits are really stringent to ensure that what we can list on our platform has the liquidity, is a real project. I mean, as we mentioned, we have like more than 15,000 assets in the world today, so we need to be very selective to ensure that we can satisfy the needs of our clients today. So looking at the top 100 coins on the market, on Bitstamp, you will be able to access to probably more than 54 today, 54 coins, where you have liquidity, where audits have been performed on security and business model is in place. So for us, that's the way we are looking at it to list new assets on the platform.
I mean, you've also touched on how since inception, it seems, the institutional kind of segment has been a kind of core segment for you. How have you seen, and Bitstamp is quite an unusual institution in that it does have the spread of the history of crypto assets. So how have you seen kind of institutional dynamics shift with regard to interest in crypto over the time that Bitstamp's been in existence?
Yes. It's also a very, very interesting question, Chris. Looking at the globe today, what we can see is I think we have three types of crypto asset usage. In some countries, crypto is really used as a payment method, right? If you go to some countries like in Africa, the people there are using crypto, to make payments, to make, e-commerce transactions, for instance, which is very interesting. In Europe or in the US, crypto is more like, an investment means for diversification. It's payment is coming, but the investment is more generating most of the volume or the revenues. Nevertheless, what we are also experiencing with metaverse, for instance, or NFTs and gamification gaming, what we are observing at the moment is a shift from not only trading, but also using crypto for gaming transactions or to purchase NFTs or arts, digital arts, notably, but also entering the space of the metaverse. So I think what we are observing today is probably three types of usage. So more like payments or trading or a combination of the two, depending on the region. But nevertheless, what we are observing is still increasing volume of transactions day after day. Looking at more assets everywhere in the world. I think Meta has a huge future. DeFi has a huge future. So we see interesting trends not only on the platform but on the ecosystem globally.
And sorry, I'm just aware that we're already running out of time. But maybe just as one last question, what do you think is kind of needed still to really drive crypto into the mainstream, or do you think it already is? I mean, it's
absolutely. No, it's a very good question. I think the evolution of the ecosystem has been articulated around regulation. If you look at Bitcoin 10 years ago, there was simply no regulation, and the fact that in many regions, many countries, crypto becomes more and more regulated. That will build, the trust. That will build probably Bitcoin being streamlined everywhere in the world. So I think from a Bitstamp standpoint, we are really supportive of more regulation to build more trust, so that Bitcoin is not only here but will last for the future, definitely.
So really having that regulatory framework in
Absolutely,
place then.
Yeah.
Okay. Well, I'm afraid that's all we've got time for today. Thank you very much for joining us and sharing your insights.
Thank you very much, everyone.
Thank you.
Pleasure to be here.
And so for our last guest today, I'm delighted to be joined in the studio by Karen O'Sullivan, who is head of the Innovation Payments, Market Infrastructures and Governance division at the CSSF. Karen is obviously an old hand here on the Focus on events, and her team and her cover everything that is related to financial innovation and act as the real sort of entry point for fintech into the CSSF here in Luxembourg. So one of the things that I think we particularly wanted to touch on today is the new guidance that came out in late November and December 2021, which you released talking about virtual assets, both in the context of UCIs, i.e. funds, but then also credit institutions. Could you maybe first talk about why you decided to publish this guidance just before Christmas last year?
Of course. So I suppose before we published this guidance, it's probably fair to say that our communications on virtual assets generally were very sparse. And I think you can more or less resume it in two warnings, so one on virtual assets and one on ICOs. Since those two warnings, which date roughly 2018, there's been clearly a growing interest in virtual assets, and we'll say all the different forms and types of virtual assets. And that growing interest isn't just a domestic interest, it's also a global interest. And if you combine that interest with the amount of questions that we were receiving, be it from our supervised entities, be it from the professional associations, or even just general interested third parties, kind of led us to the conclusion that perhaps our position or that our thinking wasn't really well known, should we say, on the market. And so we decided that it was probably a good idea to add clarity to the market and to officialize our position, or at least our current position. And that's why we went along with publishing the guidance to start with. But because of the nature of the virtual asset framework, and they're continually evolving, there is regulation that's coming, that's being spoken about, there's MiCA that's going to come in the coming future. So there's still a lot of uncertainties, and there's still a lot of changes. And that's why we thought, well, maybe the most appropriate method of communicating, we say, in a concise and a clear way to the market, and being able to adapt our message or adapt our position depending on all those changes, was to have an initial, say, communication and then supplement it with FAQs. Because in FAQ, the nature of the document, it's more flexible. It's something that we can change if we need to change, and we can change it, we say, easier and quicker. And it's also something that as time goes on and maybe other questions are coming up, or we're facing different issues from the industry or whatever it is, we can more easily add questions to the basis that's there. So that's really why we decided to publish something, and the way, or the form, if you like, that publication took.
No, thank you very much. And so as I hinted, we so far have 2 FAQs, one on UCIs addressing investment funds and their interactions with virtual assets, and then one on credit institutions. Could you perhaps maybe give us a resume of some of your thinking there with regards to those 2 FAQs? Okay.
I think, first of all, one of the other ideas, if you like, behind the guidance on a whole, was to give assurance to the market that we are open and willing to embrace the innovation. We can see and we appreciate that virtual assets generally, there is benefits, but there's also risks, and also risk of losing investment. So there is the potential benefits, and then there is the risks that are associated. And as a regulator, I suppose we are prudent. We have to be prudent by nature. So what we wanted to try and do is to open to the benefits that could be there, but all the while safeguarding the financial market and putting limits or limits in place to try and find the best solution, if you like. Why did we look or focus firstly in FAQs for the investment fund sector and the banking sector? I suppose really it's there where we're getting the most questions and the most appetite. So I think there are 2 key markets. I mean, if you look at the fund market in Luxembourg, clearly it's a dominant market in Luxembourg, and we're a dominant force outside Luxembourg in that market. So in a way, it made sense to start with an industry that firstly is so important for us, but secondly, that was coming with so many questions. And I think there clearly the questions was, what can we do? How can we structure our product? What type of assets or virtual assets could we look to invest in the different types of funds or the different vehicles? So what we tried to do through the FAQs was to give guidance as to what was available, what could be done, but the restrictions or the limits that we were putting in place, or that we feel today is necessary to put in place. So be it on the type of assets, and maybe the type of assets depending on the type of different funds that we're talking about. And it's a similar case when you move to the banking sector, in that, again, we were getting questions as to what can I do as a bank, what services can I offer? Given, again, the importance of the fund industry, there were a lot of questions around the depository type aspects of virtual assets, but also what are the virtual asset services that a bank could possibly offer to its clients. And that's why, again, the FAQs that we have are structured around those kind of questions. So in a way, it's sharing our position, sharing our current position, because as I said, it's all susceptible to change depending on what the future holds for us, but sharing our position at the moment, acknowledging the benefits, acknowledging the new services perhaps that are there, but all the while we'll say reminding the supervised entities that they have obligations, they need to protect their consumer, and that way the limits or the restrictions that we will be putting in place around some of those activities.
Yeah. So just to dig in a little bit deeper into the two FAQs, one of the on the UCI side, the new guidance suggests that UCITS, i.e., mutual funds, are not necessarily suitable vehicles for investing into virtual assets, primarily because they're targeted at non-professional, i.e., retail clients or pension funds. So how does this pair with an environment where there is obviously quite strong retail interest in crypto, directly via investments through crypto exchanges?
I think there it's important to we'll say differentiate two things. So first of all, and we always have to bear in mind our role or our mission as a regulator, which is really to maintain the solidity of the financial market and to ensure, as far as possible, of course, consumer protection. So all our actions are we'll say driven by that mission. And if you look at the two different ways, we'll say of a retail investor gaining access to the virtual world. So either it's through a regulated product, so an investment fund, or a private investment. So as a regulator, we have supervisory powers over the regulated products. We don't have any supervisory powers over individual decisions of individuals. And for us, because we need to regulate, we need to supervise the financial sector, because a fund, so a retail UCITS fund, is regulated and supervised by us. That gives a certain insurance to the investors that there's somebody there taking care of what's going on. So when we're looking at those kind of vehicles, we have to make sure that what's in there and the investments that are in there are really adapted and suitable. And that's not suggesting that virtual assets are not adapted or suitable to the general retail investor, but in an investment fund, there are inherent risks. So yes, there's benefits, but there are inherent risks which could have rather, we'll say, important consequences on the investment. And generally speaking, there may be a lack of transparency or a lack of understanding on the side of that investor who's investing directly into an investment fund. And that's why we were of the position that a direct investment in virtual assets in those kind of investment vehicles is not appropriate, because it's very hard to match the risk behind it with the message of the retail investor investing in a plain vanilla, if you like, type investment fund. When it comes to an investor making his own personal investment choices, so outside the regulated sphere, so there, first of all, there's no regulation that applies. We've no power to enforce anything, be it on the unregulated method or instrument that's being used. The same way we don't have any power to prevent or to encourage that individual from making those decisions. But what we do need to do is to make sure that any advertising or any marketing is as clear and as transparent as possible. So again, making sure that what's publicly available is not, we'll say, deliberately misleading that private investor, and that even by having his own private investment, he's aware of the gains, but also of the risks that are linked. And that piece of our job, what we do is it's not within the investment funds and regulating the products, it's more through the financial education initiatives that we take. So trying to make sure that the public are as aware as they can be of those inherent risks, and that there is well-informed, and not well-informed as in a well-informed investor, but as well-informed as possible before they make those personal decisions.
That makes sense. And on the credit institution side, if I understand correctly, the new FAQ distinguishes between different account forms for credit institutions with respect to virtual assets. Essentially, securities accounts are allowed to be open for virtual accounts, but for virtual assets, but current accounts aren't allowed to be opened. Could you perhaps explain what the distinction that you're drawing here between securities accounts versus current accounts with respect to virtual currencies and virtual assets, and what the kind of rationale is between allowing securities accounts but not current accounts, essentially?
A lot of it is to do with the nature of the asset itself and the nature of the account and the purpose of the account. I mean, virtual assets, virtual currencies, crypto assets, cryptocurrencies, there's lots of words, there's lots of terminology without having a single definition or per se. And even within virtual assets, it's so diverse. There's so many different assets in there. They don't have all the same risks. They don't have the same rights. They don't have the same obligations. So it's very difficult to put a virtual asset in a particular bucket. But then if we look at the difference between, say, a current account and a securities account, if we look at a current account, I mean, essentially a bank gives a current account to its customer. And the purpose of that current account is for the customer to place funds or fiat currency on that account for it ultimately be used to make payments at a subsequent time, or indeed to withdraw their funds. But the very important notion there is funds or fiat currency. Currently today, virtual currencies have not been qualified from a legal perspective as a legal tender. So it's not a fund, it's not a fiat currency. And that's why basically you can't have a current account in a virtual currency. It can be used for payment, but that's in a different scenario. Yeah. So really, the basis of a current account isn't appropriate because the legal qualification or the characteristics and conditions to permit such a legal qualification as a fund isn't there today. If you look at the securities account, it's a little bit different because the nature or the reasoning behind a securities account is somewhat different. So a securities account is where essentially you can put an asset and it can be safeguarded by the bank. That asset may be your traditional stock and shares, but it could be something different. So it could be a piece of art, it could be bottles of wine, it could be fancy cars or whatever. So the nature of the assets that can be safeguarded by a bank today is much broader. And that's why virtual assets are something that then could be safeguarded by a bank. And that's why they can be on those accounts. What's important though is that if a bank is going to offer those kind of services, there's different ways that they can be offered. So either you're looking again depository towards the investment fund, where there's different rules and due diligence and responsibilities that come into play. If it's a securities account for an individual, well, there again, it's important that the bank is very clear to that individual as to what does that safeguarding mean? So is it physically, well, it's very hard to physically hold a virtual asset, but is it something that's been physically maintained? So is the bank, we'll say, physically maintaining the private keys, for instance, to those assets? Or is it providing a safeguarding service, but the actual safekeeping in a traditional sense of the word is being done by perhaps a wallet provider behind? And in those cases, what's very important for the bank is to make sure that it's clear for the customer where the risk is and who's responsible. So in a way, where does the bank's responsibility stop? Yeah. So if the asset disappears, and where is that liability passed either to the dedicated specialized third party or indeed back to the individual itself. Yeah. So it's really the nature of the account and the nature of the assets which makes the difference in treatment. Yeah.
Okay, very interesting. I mean, one of the questions that I think lots of people are asking at the moment is: do you think that do you think that there's an increasing sort of interest in the industry on the part of funds and credit institutions? In the case, obviously, of the FAQs, is there an increasing interest for those kind of firms to offer these kind of crypto services? Is that something you're seeing on your side? So
it's not, I can't say it's something that we've seen specifically since we published the FAQs at the end of last year, but I think it's fair to say that over the last year, 18 months or so, there has been generally an uptake in interest. We've had a lot more contact, we've had a lot more questions, we've had a lot more meetings, exchanges as to what's possible, what's not possible, and things like that. So the interest is there. I think though today when we look at where we are, the concretization of that interest into actual projects is a little bit slower. I don't know, is that because there's still, our position in publishing the FAQs is one thing, it's a certain amount of clarity or legal certainty to a certain extent that we can give, but there's lots of other things that are going to come in the coming months, notably MiCA. Yeah. So I don't know, is the concrete projects on hold, waiting to see what that's going to bring, or if it's just generally the ideas are there, but it's very difficult to actually put it into real terms. And I think for us, really what we say to notably banks and investment, say managers or funds, whatever who come, is that the rules are there, the same rules apply, and it's really a question of adapting those rules to a new type of assets, but ultimately the rules are the same. Yeah.
Yep. And just as a final question then, what advice would you give to a firm who's interested in providing services related to virtual assets in terms of how they should deal with you at the CSSF?
So I'd say there's a little bit of homework to do on their side before they come. I mean, as we say, and we continue to say, we are open to exchange and discuss projects. It's not that. But I think before coming with a question or with a project, what's very important is to firstly, for the individual company, whatever, to have a look at the virtual asset services that exist in the law today, for which a registration is required, to see if, firstly, it's one of those services that they would be interested in providing. Because if that's the case, it's a certain process that needs to be finished to be registered with us before they can provide this service. If it's a supervised entity, currently supervised entity, it's important then for them to open the discussion as soon as possible with us. So with their line supervisors to start with, who then internally, if needs to have other experts, will call us, but it's to start that discussion. So once the entity knows, well, am I looking to provide one of those services, or am I just looking to provide something linked that's not needing a registration, to come and contact us. Before a project can really kind of get off the ground, it's up to the entity, again, particularly a supervised entity, but any entity has the same obligation, is really to do their due diligence. They need to fully understand what the project is. They need to fully understand what the risks of the project are. And it's good having the benefits and having the revenues and whatever else, but really to fully understand what the risks are and make sure that they're mitigated insofar as possible. Need to make sure that, say, if it's an existing entity, a supervised entity going into a new service, that those kind of services and the risks that those services may bring are in line with the risk appetite, and to make sure that that internal assessment is done. So really make sure that kind of internal assessment and reflection is done, is formalized to a certain extent, and then to come and discuss with us or to exchange on the project. And then sometimes it's something that can continue. Sometimes we may need to kind of reorient one piece or the other, but then the discussion can really take off when we have something to base it on.
Okay, so in other words, do your homework, but then do get in touch. But do call us, yeah, indeed. Karen, as usual, a pleasure to have you with us. Thank you very much for being here today.
Thank you very much.
And of course, you can access those FAQs on the CSSF website, along with a new white paper on DLT and blockchain that they published last week on the 21st of January. So just to sum up the events today, the various speakers, I mean, I think one thing that is very clear is that the industry is still very much in flux. It's in change, both in terms of use cases, in terms of the infrastructure that underpins the industry, and obviously the regulatory framework. You know, we're still waiting for the full developments there. Sustainability is also a key issue that hopefully will be solved going forwards, and obviously is being worked on, but is still kind of at an initial stage of development there. And the other thing to note, I think, throughout is the kind of increasing appeal of these kind of asset classes to investors, also institutional investors, and the opportunities that they present both to incumbents and also to new players. So that's all for today. All that remains for me to do is to thank our sponsor and to encourage and to thank our audience and to encourage you to check our website for upcoming events. So thank you very much, and hope to see you at another LFF event soon.